On February 27th, 2020, the headlines read, "The Dow Jones logged its worst day in history." I can't believe that this is the worst stock market crash ever. On March 9th, 2020, the headlines read, "The Dow Jones logged its worst day in history." I can't believe this is the worst stock market crash ever. Wait, didn't this just happen? And if it is the worst stock market crash ever, then wouldn't it have to be even bigger than the Great Depression? Something seemed a little strange here, so I decided to look into this a bit more. It turns out 5 of the last 7 biggest point drops in the Dow Jones occurred in the last couple weeks. Is that because we're experiencing the most volatile stock market in history? Or is it because the media is intentionally parroting out a misleading headline? Hey everybody, I just thought that I should probably preface this video because of the way things are heading. So I just want to make it very clear that this video is not saying that the stock market is not doing poorly right now. It definitely is. I think that the S&P 500 is down another 8 point something percent right now, and we are definitely heading into some dicey territory for sure. What I'm really trying to say with this video is I'm talking about the Dow Jones and how Dow Jones headlines can definitely be misleading and contribute to a lot of the panic that we are seeing in the market. Again, I'm not saying that the markets aren't doing bad. They are doing very poorly right now, for sure. But it's not the worst that they've ever been. We've been through way worse things in the past. So with all that being said, if you are somebody who is panicking right now, I'd recommend that you really check your risk tolerance. I just put out a video on that. My previous video, you can check that one out, which tells you how to determine your risk tolerance for your investments, because if you're panicking, then there's a good chance that you are not in the right investments for you. You should be able to sleep at night no matter what you're invested in, even if the stock market does this, because I hate to break it to you, but if you're investing in the stock market, it's gonna do this. And if you're investing for the long term, it's gonna do this again and again. So you better be prepared for this type of thing. So I hope you enjoyed today's video, and check out the risk tolerance one too if you want to learn more about that. And now, the video. If you've been following the stock market so far, then you're probably familiar with the Dow Jones Industrial Average. If you're not, the Dow is one of the oldest gauges of the health of the stock market. It was created way back in the 1880s by a man named Charles Dow with the purpose of tracking the stock market in the United States. It accomplishes this by tracking 30 large corporations in America like Exxon Mobil, Microsoft, and Disney. The idea is that these 30 companies are strong and stable. And by tracking them together, it can give us an idea of how the economy is doing in the United States and therefore the stock market. This was a great plan, and at the time, it served a really useful purpose. However, fast forward to 2020, and I can't help but scratch my head and wonder why we're still talking about the Dow. This is because the Dow Jones Industrial Average is actually a really bad way to track the stock market. Allow me to explain. It all starts with the Dow being a price-based index. What does this mean? Well, basically, the Dow takes these 30 large companies and then it adds up their share prices together. And then it takes this number that you get from adding up their share prices and divides this by something called the Dow divisor. And this spits out an approximate average of the share prices of all of these 30 companies. The problem is that using the share price for these companies as a way to track them actually doesn't make any sense. Let's say, for example, that we had just 3 stocks in the Dow: Apple, Amazon, and Facebook. Apple shares trade for around $266 currently, Amazon's for around $1,800, and Facebook for around $169. Apple is the largest company. It's worth about $1.2 trillion. Amazon is worth $900 billion, and Facebook is farther behind at $500 billion. Logically then, we would be able to assume that Apple should have the largest impact on our hypothetical Dow Jones average, right? Because it's the largest company out of the 3. Strangely, it actually would not. And that's because Amazon actually has the highest share price, so it would impact the average more than the other two companies. And that's because, let's say Amazon and Apple both increased in value by 10%. Well, if Amazon's share price is $1,800, then that means that Amazon would increase by $180. Whereas Apple would only increase by $26. So Amazon would have a way bigger impact on the overall average because the Dow Jones is a price-based index. This is a huge problem because share price has nothing to do with the size of the company. Apple is obviously a way bigger company than Amazon. Amazon has a higher share price than Apple. But that doesn't actually mean anything. It doesn't mean that Amazon is worth more than Apple. A company's share price is only relative to its own share price. You wouldn't compare the share price of Apple to Amazon to see which company was worth more money. Here's a crazy example. What if there was a company that was worth only $1 million, a very small company, but its share price was worth $10,000? Well, then this super small company would have a massive impact on the Dow Jones Index because the share price is $10,000, so a 10% swing in the share price would be $1,000, which would impact the Dow Jones greatly. But this wouldn't make any sense at all because the company is so small, only valued at $1 million. A company this small would have virtually no impact on the economy. So why would it have such a big impact on the Dow Jones? It doesn't make any sense. And that's because it doesn't make sense to base an index off of the price of a share, at least in 2020. A more logical way to create a stock market index would be to assign each company a weight in the index based on their size. Larger companies would have a bigger impact on the index and smaller companies would have a smaller impact. This makes sense because a huge company like Apple would have a massive impact on the economy, whereas a small restaurant chain probably does not. Fortunately, we actually have a lot of stock market indexes like this today. One of the most notable examples is the S&P 500 index, and that's because the S&P 500 is a market cap weighted index. And what that means is it assigns weights to all the companies in the index based on their size. In the S&P 500, Apple is the largest company because it's the largest publicly traded company in America, so Apple has the biggest impact on the S&P 500. If the S&P 500 were a price-based index, then a company like Amazon might make the biggest impact on the S&P 500. And we know that that doesn't make any sense because Apple is bigger than Amazon. So if the Dow Jones Industrial Average doesn't really make sense to use as a stock market index, why does the media and even people on YouTube continuously point to it to create headlines? The answer is actually quite simple. What sounds scarier? The Dow Jones had its worst day ever in the history of the world. The Dow Jones had its 50th largest percentage drop in one single day. Obviously the one that says, worst day ever in the history of the world. But the fact of the matter is that both of these statements could simultaneously be true. On February 27th of this year, the Dow Jones had its single largest point drop in one day in the history so far, but when that equates to a percentage of the actual value of the entire Dow Jones together, it's not even in the top 20 largest drops. So in reality, this drop in the Dow Jones that media headlines were saying was the largest in history wasn't even close. Not by a long shot. The percentage drop was actually not that bad, historically speaking. But the media isn't going to get clicks by telling you that. The media is going to publish a headline with an angle that's going to try and drive engagement. And the Dow is an easy target to find these angles to make something appear much different than it actually is. So that's why you'll see the media, news agencies, or whoever point to the Dow Jones when they want to make a headline. It's an easy way for them to make it seem like the sky is falling and cause a lot of panic, which gets them a lot of clicks. But in reality, on February 27th, this was just a decent dip that had been seen several times before across the history of the Dow Jones. When looking at indexes, or investments in general for that matter, what's really important to look at is the percentage change. If the Dow Jones falls by 1,000 points or 100 points, it means nothing to me unless I know what percentage that corresponds to. The February 27th drop in the Dow Jones was the largest single day point drop in history, but the percentage drop was only 4.42%, which again was not even in the top 20 largest percentage drops in the Dow. However, on March 9th, when the market had another big drop, they put out the same headline again saying that the Dow had its worst day in its history, but the difference was that the percentage drop was actually quite big. The percentage drop of 7.79% was actually the 11th biggest drop in the Dow Jones. So now we're actually talking about a pretty big drop. But the thing is that they published the same headline twice. The first time on February 27th, it wasn't even close to being true. It wasn't even close to being the biggest drop in the Dow Jones in history. But on March 9th, it was a little bit closer to the truth. And the way you find the truth is in the percentage. The percentage is really what matters. But the media is not going to point that out for you. A second reason why the Dow is the poster child of stock market news is because the Dow Jones has a large value. A 2,000 point drop sounds a lot scarier than a 200 point drop like the S&P 500 might experience. If you understand that the media is always trying to engage an emotional reaction from you, because then that gets you to click and read and engage with them, then you'll understand this ploy very easily. Another thing to keep in mind is that as the economy grows, as the stock market grows, the indexes are going to grow in value as well. So the Dow Jones is going to increase by thousands and thousands and thousands of points over time, which means that when it does have a drop in value, those drops are going to be bigger in terms of points in the future than they are today. And that's why we've seen so many of the largest drops in points in recent history, in the past few weeks only. If you're comparing an index that's 100,000 points to an index that's 1,000 points, when this index drops by 10,000 points, that can seem pretty crazy. But then you have to keep in mind that that's the equivalent of this index dropping by 100 points. It's because it's about 10% of each. So as the Dow Jones continues to rise in value, and as the media continues to say that it had its largest point drop in history, just remember that the points don't actually matter at all. It's the percentage that matters. Because in the future, as it does increase in value, I'm sure there will be more headlines that say it was the worst day in the history of the Dow, when it really was not at all. And honestly, I think this practice is really crappy because I personally know a lot of people that have been emotionally affected by the drops in the stock market. But what hasn't helped is the media parroting out these stories that make people really start to panic because they don't understand that the Dow Jones is probably not the best index to look at. For someone who's not that knowledgeable about the stock market and they watch their investments fall by a good amount and then also see the news headlines telling you that it was the worst stock market drop in history, it's gonna make you panic. And I personally know a lot of people who are panicking, people who are in retirement who are feeling extremely scared. So yeah, I mean, I'm honestly pretty frustrated by it. And I would like that to change, and I would like there to be definitely some more transparency, but that might be being a little optimistic. If you're relatively new to investing, then one of the best skills that you can develop is to understand that stock market news is terrible. It oftentimes provides no real value and is usually just inciting fear or euphoria so that it drives engagement to the news story. Always remember that whether it be news, ads, or any other form of marketing, the goal is to always elicit an emotional response from you to drive engagement. And of course, another aspect of this is that the Dow Jones Industrial Average has a very long history in the stock market and it's deeply embedded within it. it. Many investors grew up watching the Dow as their way to measure the health of the stock market, and it became the traditional index to use. As I'm sure we're all aware, traditions and practices that are embedded in cultures are very hard to uproot, and that's for good reason. It's important to preserve the history of things. The Dow has been such an iconic piece of stock market history, and I can understand that a lot of people are not ready to let go of it quite yet. But we also have to pair that with the understanding that the Dow Jones is now understood to not actually be the most reliable way to measure the health of the stock market. Virtually everybody would agree that a price-based index doesn't make as much sense as a market cap weighted index. Personally, I never check the Dow Jones. I like to look at indexes like the S&P 500 to see how the market's doing. But if you do choose to look at the Dow Jones Industrial Average, then just remember to not pay too much attention to the points, and what you really want to look at is the percentage change in value. So the next time one of those headlines comes out, just say, "Shut up and show me the percentage." I'm Steve Antonioni, and this has been Cash College on the Dow Jones Industrial Average. Thank you all for watching, and I will see you again soon.